Welcome, everybody. Thanks for coming here to the talk. I'm Joe Labriola. I'm a research assistant professor at CFP, and I am pleased today to introduce Ségal Guern Herry. He is an assistant professor at Aix-Marseille School of Economics and senior economist at the EU Tax Observatory. Currently, he's a visiting researcher at UC Berkeley in spring 2026, and so he's going on a U.S. tour presenting on. His current work focuses on the equity and efficiency implications of the taxation of high income and high wealth individuals. Ségal studies how households respond to taxes and the implications of these responses for tax progressivity and inequality, with particular interest in wealth taxation and tax evasion. Ségal has published in the Journal of Public Economics, was awarded a Fulbright scholarship to attend UC Berkeley, and received the Young Researcher Award of the EU Tax Observatory, among other awards and fellowships. A couple of housekeeping things. So we have the mics on in the room, so we'll pick up any side conversations you're having, so please don't have that. Welcome. Ask questions, raise your hand, ask questions. Since Ségal is an economist, and he refers to that way. All right, and so please join me in welcoming Ségal.
Thanks much, Joe. It's a real pleasure in Berkeley, and so I'm very happy to come here during my time in the US. And I would say I'm quite surprised how warm it is right now. I was expecting to be freezing, but actually I'm not at all. The talk, so do I have an hour 30?
Hour 30.
Hour 30, okay, perfect. And yes, please do ask questions as I go. And we can also have some. The paper that I'm going to talk about today is about wealth taxation, and it's focused on funds. So, yes, the way to motivate the paper, let me stress that wealth taxes today are at the standard stage of all tax policy. Economists, policymakers, sociologists, and many others, driven by the rise of wealth inequalities in many countries. And the US is one of the examples, one of the countries where actually wealth inequalities have increased massively over the past decades, and also fueled by the need for fiscal revenue. So wealth taxes are seen both as a way to address inequalities and to raise substantial revenue. But when we think about wealth taxation, a fundamental question that comes to mind is sometimes more about how we can design wealth taxes, more than whether we should have wealth taxes. So the question here I'm going to address is, provided we want to have wealth taxes, what should it look like? What should the tax base do? And here there are opposing views among economists. On the one hand, some economists argue that some assets should not be taxed, should be either less taxed than other assets, or completely exempted from the wealth tax base, because taxing such assets may raise liquidity issues, or because some assets are particularly elastic to taxation, or because they generate positive externalities for the economy and therefore should not be taxed or less taxed. While other economists argue that we should aim for a comprehensive wealth tax base in order to limit the tax arbitrage, maximize to reduce the scope for tax avoidance and maximize tax revenues. And this is a debate that is important for wealth taxation, that are as a tax tool meant to tax the very rich household, but it's also something that is important when we think about taxing the total household stock of wealth in general. And as a way to illustrate it, let me say that most countries have property taxes today, tax the ownership of real estate assets. But comprehensive wealth taxes are much more rare. So it means actually, when we talk about taxing the household total stock of wealth, there is already a wide tax differential across asset types. So it's really something that is important for the tax design in general. And so the question here is how to design the wealth tax base. And so when we think about this question, the parameter is the cross elasticity between assets. The cross elasticity is the extent to which, if two assets are taxed, taxpayer would respond to it by reallocating their portfolio away from the taxed assets and in favor of lightly taxed assets. And it's a key element because it first informs us about the efficiency cost of differential taxation in an optimal tax perspective. A high cross elasticity between asset classes would mean that it's very costly in terms of efficiency to tax different assets differently because of tax revenues, and it creates high distortions. And also, if you think of governments that may want to shape household portfolio choices in order to incentivize households to invest more in some assets rather than in others, then this cross elasticity also tells us the extent to which taxes can be an efficient tool at shaping such household portfolios. So this cross elasticity is a key parameter in this question. And the problem is that it's a parameter that is particularly hard to measure, hard to estimate for different reasons. First, because we often lack data on household stock of wealth, broken down by assets. Basically, we have good wealth information with data information in countries where we have wealth taxes, and only a few countries have such taxes. And second, most of the time, when there are tax asset-specific tax changes, these changes together with other changes in the tax schedule, making it quite difficult for researchers to identify a portfolio reallocation response to taxation, as opposed to other behavioral margins of adjustment, including the migration response or the evasion response, savings response. So it's important to have important, compelling research designs to estimate this parameter. And then, since responses at the top matters, because of the high concentration of wealth, well, in many contexts, looking at the very top of the wealth distribution make researchers run into small sample sizes too, because most of the countries that have wealth taxes are typically Norway or Denmark, just typically small countries. It's very hard when we start to look at the very rich households, big enough samples. So here in this paper, I try to address these limitations by focusing on the cross elasticity between real estate and financial assets. So the idea is to estimate this cross elasticity, basically to estimate the extent to which a tax differential between real estate and financial wealth triggers the allocation response. Then to document the mechanisms behind this reallocation response, why some taxpayers engage more in reallocation than others, what are the limits to this reallocation, and then to assess the revenue impact of this reallocation. This last part is basically telling us what is the efficiency cost of taxing real estate relatively more than other assets. And for this study, my laboratory is France, and in particular, the French wealth tax. So France is a nice setting because there was a wealth tax that was introduced in France in 1981. And from the beginning, this wealth tax excluded the business assets from the tax base. So the idea was that business assets were at the heart of the French economy. So it was important to not prevent households to invest in their firms, and therefore the business assets were already exempt. But in 2018, the government went one step further and excluded all financial assets from the tax base. And so the idea at that time was to say, so it was Emmanuel Macron who came to power in 2018, and who said that real estate is less of a productive asset for the economy than financial assets. So we can think about whether this is true or not, and this was really the discourse at that time. And therefore, the reform was meant to incentivize households to reallocate portfolio away from real estate and toward financial assets. And it's really a major wealth tax reform because the wealth tax revenue were cut by more than half as a response of the reform. So it's a big change for the wealth taxation landscape. And it's a useful setting because, importantly, the features of the French wealth tax, so the tax schedule, the tax rates, the exemptions, are unchanged. And in particular, the rules surrounding the taxation of real estate are not changed. So it means that the reform reduced the incentives for households to hold real estate, but not by increasing the tax rate on real estate. It did not increase, but only because it's less profitable relative to financial assets, real estate after the reform. And the second nice setting that allows me to estimate this parameter is the specific rule for non-resident. So this non-resident, even before the reform, they are subject to the wealth tax if they own a substantial amount of wealth in France. So the non-resident can be American tax residents or German tax resident own wealth in France. But even before the reform, they would be subject to the French wealth tax only for their real estate wealth that is located in France. So it means that even before the reform, the tax base for this group is only their housing wealth, and the reform does not change the incentives to hold real estate versus other types of capital. They can use this group as a portion in France in different systems. What do I find? I first find that 5 years after the reform, the French taxpayers have relocated on average 5% of their stock of real estate toward financial assets. And in order to quantify the magnitude of the reallocation, I compare this reallocation to the size, the magnitude of the tax incentive. Compare this, translate it into a cross elasticity. And when comparing this cross elasticity in this context to comparable estimates in the economic literature that have tried to estimate the balancing response across different types of financial assets, it suggests that this elasticity between real estate and financial assets is rather modest. It's much more modest than in many contexts when the literature on substituting across different types of bonds and equities, for example, or different types of businesses. Now, what are the mechanisms behind this? So what can explain the rather modest response? Well, the first explanation is that there is little room for pure volumes. So the elasticity are not structural parameters. It means that they depend on the tax base, the tax schedule in general. And here in the French context, the tax base for real estate is relatively broad. It includes both real estate held directly and real estate held indirectly. So it means that it's not possible for taxpayers to reduce their level of taxable real estate that reducing without really selling product. So this is the first explanation behind the rather small response. The second is the constraint imposed by consumption housing. So basically, primary home and owner-occupied secondary housing. And what I find is that even when we look at wealthy taxpayers, so at the top of the wealth distribution, well, this consumption role of housing plays a role. And when we tone down the consumption role of housing, the response is actually higher than when using this, when total housing wealth. And third, I also suggestive evidence that portfolio diversification explains some part of the small reallocation. So the estate is very different from financial assets. The returns evolve very differently, and it's just maybe very optimal for taxpayers to hold some types of housing wealth in their portfolio to hedge against financial risk. And also financially interesting, I find that taxpayers who are more aware of the tax code and financial opportunities are actually more likely to engage in rebalance. And third, the revenue. I'm sure that between the revenue, the wealth tax revenues after the reform, between 9% and 30% higher, absence this real. This is non-zero. It means that actually this costs some money, but it's overall relatively modest. So what are the implications of these results? Well, first, the stated aim of the reform was to incentivize households to invest less in real estate and more in financial assets. So in light of this objective of the reform, well, this reform, because the reallocation was not massive, primarily functioned as a tax break for the wealthy. Second, the bad news. But the good news is that since this cross elasticity is relatively small, it means that it may be possible for governments to tax real estate progressively and relatively heavily without triggering a massive portfolio allocation away from real estate, which means that progressive property tax may be an efficient tool to raise social tax revenue. So this is more of the good news. Now, my paper speaks to different literatures. The first one is the obvious literature on differential taxation and portfolio structure. So there's been a wide literature in economics on this topic since the 1980s. Basically, the findings in the literature is that, of course, tax difference matters a lot. But most of these papers, so in the income tax literature, inheritance tax literature, also the literature on tax-favored retirement savings plans, show that there is a history of substitution across assets, but they mostly focus on different types of financial assets. And so my contribution is to look at another asset class that is very different in nature, namely real estate. The second contribution is to the literature on behavioral responses, wealth taxation, with the growing literature today. And paper in this literature basically estimates what we call wealth tax elasticity. So to what extent, if you increase the tax rate on the wealth tax rate, will respond to it by reducing their taxable wealth. And this elasticity can be driven by a reallocation response, but also by savings response or other types of response. And my contribution is to be able to identify specific one type of channel. This elasticity is a key parameter when we think about how to design the wealth tax base. And third, there is a wide literature in finance about portfolio choices and the specific role of housing literature. And here, these papers, mostly theoretical papers, have identified the constraint imposed by the consumption role of housing in household portfolio choices. And what I find is that it's true. There is actually a constraint imposed by consumption housing. But even when we abstract from the consumption role of housing, so when we abstract from primary home, secondary housing, housing is still a specific asset, and the taxpayers care about keeping some of housing in the household in their portfolio. So there is no question. So I will jump to the institutional context of the data. So first, when we think about the French wealth tax before the reform, we should think of it as affecting roughly the top 1% of the distribution. There is an exemption threshold. 99% of the population is exempted from the tax, and it only affects the wealthy taxpayers. And so the tax schedule, both before and after the reform, doesn't change. So there is an exemption threshold, 1.3 million euros in taxable wealth, so basically $1.5 million, and the rates are progressive, go 0.5% to 1.5%. The tax base for the French worldwide real estate and worldwide financial assets. Well, after the reform, the tax base is reduced to real estate only, but importantly, it includes real estate held both direct and indirect. So there is no incentive to change the way also. And for the non-resident, both before and after the reform, the tax base is how much real estate they own. So this graph illustrates the tax change by the reform. Was there a question?
No, I think you said it. You said it in the slide. What happens with non-French financial assets for non-residents? Does that have an impact on your cross elasticities?
Non-French financial assets. I observe what happens in France. So I can't observe what is not taxable in France. So I only observe the French portfolio, and so since this non-resident, so their portfolio may be affected by many shocks over the years, but they come from different countries. So I assume that there is not one specific shock non-resident portfolio.
Oh, so these are non-French people living in France.
So the French taxpayers are those who are, and the non-resident would be, for example, an American citizen who owns a house in France. Again. Yes.
I think I've been misunderstanding something, and I think you just clarified it. But so these are taxes that are only going to affect the top 1%, both before and after.
Absolutely, yes.
It's not like our regular. We shouldn't think about this as like property taxes in the U.S. at all.
No, exactly. So I think it can still tells us something about property taxation, but This is what
allows me to abstract from big price effect of the response, for example,
and it's it's
about the top of the distribution here.
So if like 1 million euro house and 2 million euro in financial assets after this reform, do I get tax still on my real estate because my net worth is over 1.3 million, or is it only if my real estate is over 1?
Yeah, it's the second option.
So it's only if you real estate. So this means that,
I will give you some details about my specification
strategy, but
my treatment group would be taxpayers who remain liable to the wealth tax
after the reform, even if they don't do anything, so taxpayers who
own more than the threshold.
own real estate.
Yes.
For the purposes of the wealth test, how are property values being measured? Is it just self-reported? 'Cause I imagine worldwide.
Yes. So
It's self-reported, but it should be reported
at the market
value. And so
there was
so in 2014,
there was a tool that was introduced on the website of the government, try to simulate the
property values
based on comparable transactions.
and so
Taxpayer is self-assessed tax
free
to put what they want, but in case of audit, if there is a
big gap between what is
simulated here in the simulator
and what was reported, then the taxpayer
would have to justify.
the results. And so
I'm not claiming at all that there is no underreporting, and I'm sure
that there will,
and the
that there is.
um,
The nice
thing with this feature is
that the tax rate on housing does not increase, and therefore the incentives to
report
or
orthogonal to the reform.
this is what I can.
Any other questions about the context? Okay.
So basically what we have for the French taxpayers, so before the reform,
The top marginal
tax rate is at 1.5% for both housing.
and financial wealth. And then in
2018, it's
reduced to 0%,
on financial assets,
and then it remains.
at 1.5% on housing wealth.
So
It's basically
a maximum of
1.5% tax differential between housing. And you may think that it's a small
small differential, but
but here it's
important to have in mind that it's a
wealth tax
rate. So it's like
taking 1.5% of total stock. So if
we assume a 4.5% return,
it's like 30%, 30%.
tax differential. All right,
Let me give you a few details about the
resident instance, because there was a question.
and I think it's important to fix ideas here. So there are three conditions to be
Non-resident for tax
tax purposes in France. So first, the main home
of the tax.
taxpayers have to be located outside of France.
Second,
The taxpayer should not have any significant professional activity in France. They can
own hold assets, but
not
have significant professional activity.
activity. And then
The main economic interests of the taxpayer should.
outside of France. And so
Who are they? Well, actually, they count for 1.5% of total residential real estate
estate in France in 2019.
total. And there is importantly
There is a stability in 2009.
2009 and 2019 in the ranking among top owners. So it means that there is not just like a lot of
British owners would go to France
France and buy a lot of properties after
Brexit. So what I find is that there
is a stability
among the top
owners. The first country, though, is
UK.
and importantly,
It's important to have in mind that a large share of these non-residents have strong roots in
France because 42%
of them
are born in France. So it's taxpayers who have
have left France
France for
reasons for
work,
but they
for still.
bounce to France. And so here in this
Context, I'm not going to talk about migration,
context, that there have been a paper
showing that
there was a very slight
a reversal in the
trend of migration.
migration. So
Some
some
non-residents
residents came back
back to France as a response of this reform, although
in
in
terms of magnitude. Okay, the data now.
so we have
In France, access to
comprehensive wealth tax returns, providing information on
on taxpayers'
portfolio.
composition.
So
Importantly,
it's only above. So there is a specific rule before between
from 2013, I can observe portfolio composition only from for taxpayers who own more than 2.57 taxable wealth. So I'm going to focus on those taxpayers, very rich taxpayers. And so when available, I have
information
wealth with the difference between farm and the rest of housing. Also have information
on non-housing real estate, so forests,
farms, which actually benefit from tax rates. Also information on financial wealth, so the stock
of insurance, deposits,
and other elements
that
are taken into
account in the computation of tax liabilities,
debts and
tax credit.
Does your non-housing real estate include commercial real estate?
Yes, so it
includes both, as long
as yes. So importantly, I mentioned briefly
before that business assets
part of the
tax base, both before and after
the reform.
So it means that if your business is renting commercial properties, it would not be included here.
But it's both before
and after.
And so what I
can do is to match these tax returns to income tax returns, where I have information on income
by type, so dividend,
interest, rentality,
social demographic characteristics. And fortunately,
I don't observe what is not taxed anymore. So I don't observe financial assets when it's no longer taxed.
But
financial income remains taxed. So I can actually observe the evolution of financial incomes
before and after the reform and show that it actually increases
after the reform, which is suggestive
of a reallocation. Now let me jump to the main,
which is differential wealth taxation portfolio allocation.
So my treatment groups, I will estimate the results,
the difference in difference setting,
where I
will look at the evolution of real estate
before and
after the reform. And the treatment group here will be taxpayers who remain
liable to the wealth tax
absent any portfolio reallocation. So they own
in real estate more than 50%.
And those guys, they are very rich on average, so they own 6.5 million euros
on average,
and 55% of this is housing.
Importantly, since we should have in mind that business assets are not included in the tax base. Actually, those guys they are richer than the wealthy population, and then on average they have 270,000 euros in income, taxable income, and 38% of this income. For the control group, well,
yeah, you said, I think on the previous slide, you said you observe folks who have wealth above 2.5 million. So this is treatment group is people with real estate above 1.3 million among the sample with wealth above 2.5 million.
Yes, absolutely. So the taxpayers are those who more than 1.3 in taxable wealth. And for the taxpayer who own below this threshold, the 2.57, I only observe total wealth. So I focus on taxpayers, report the detailed tax returns.
And how many people is that? Like what proportion of all taxpayers fall within this threshold where you don't have the granularity?
And so here my treatment group is composed of 21,000 people, while I mean in total there are 350,000 wealth taxpayers in France before the reform, and the detailed tax returns. So I don't have it on top of my head, but it must be something like 60,000 taxpayers. And among those, there are like 21,000 who own more than 1.3 million. So here, I mean, we know as we move up to the top of the wealth distribution, most of the composition of is mostly financial assets. So here we're looking at
And is the control group also subject to that limitation of the 2.57? Just know that that's all.
Yes. So they are, except, so it's a weird rule, except if they go to the income tax. But actually, since, as you said it, since the total, their taxable wealth is nothing, I can actually look at, take the whole group, which is good because it allows me to look at taxpayers, not resident taxpayers, who own 1.5 million in housing wealth, 2 million, etc. So it allows me to enlarge the control group. So this is what I take. And so those residents, they own almost 3 million euros in housing wealth in France, and around income is around 50,000.
There are around 250,000 taxpayers. What?
So the number of taxpayers in total in France before the reform is 350,000, and after it reduced to 130.
But there's so few taxpayers in
Well,
wealth taxpayers. Okay, I got it.
Oh yeah, wealth taxpayers. Sorry. Yeah, no, there are 37 million of
Yeah.
taxpayers.
Right.
not this did not in response.
I mean, as a result of the reform. Yeah. No, but here I was talking about when I say taxpayers, I mean wealth taxpayers.
Thank you. I'm sorry.
Okay, and so the outcome.
Outcome will be real estate wealth.
All right. So this is
The road license.
over time. So what we see that between
2013 and 2017,
for the French,
taxpayers, wealth taxpayers in red, and the non-resident taxpayers, we see that
the evolution of
taxable
real estate is relatively similar,
similar.
or if we normalize to
2016,
to zero,
and then there
there is a gap.
that enlarges over time.
And so again,
This gap is not driven by an increase in the tax rate on housing, but by a decrease in the tax rate fund.
which is what allows me to interpret this as reallocation response rather than other margins.
Response to that.
If we just take
Now the difference between the two series, this is the main
different
graph.
so 5 years in 2020,
5 years after the reform has been implemented, the
housing wealth of
taxable housing
wealth
reduced by 5% on
average among the French
average.
relative to the 2016. And importantly,
Most of the drop happens 1 year after the reform.
which allows me to rule out that temporary portfolio adjustment
Friction.
or here playing a huge role, because if they were very high, then we would see something much more aggressive than looking at response would happen. Now there are a number of assumptions that we need to make, and a number of
Robustness checks that I took.
the main assumption.
The main threat to identification in this study is the possibility that the inflation faced by the stock of housing held by non-residents and the stock of housing held by French taxpayers is different over time. So in France, there was a relatively high house price inflation after the reform. And so if this inflation is different groups, then I could interpret
the gap between the two as a reallocation response,
well, actually, in fact, it would be.
due to different. So how I
Did with that, I use completely
external data sources,
which are the comprehensive property tax record in France matched to transaction data, where I have information on household stock of gross
wealth,
and where
these properties are located.
And what I do is I base on wealthy
Taxpayers
so who are likely affected by the
reform
and
look at their stock
of housing in 20. And what I can, importantly also, I can observe the address of the
owners of each
property, so I can know whether
an owner is
it's a non-resident or
whether a person
is actually living in France. What I do is I look at the wealthy taxpayer and their stock of housing in 2016, and look at this stock of housing, the price of this stock of housing evolved over
time between 2016 and 2022,
differentiating between
the non-resident and the French taxpayer. So let me show you
this house price index. And so this is basically an evolution of the house
house price index,
for the two groups.
and I think it's quite
Reassuring here. Indeed, there is a house price inflation after the reform, but it's very similar among the two groups.
It allows me to rule out that actually the gap that I observed in the graph before is driven by different house price inflation and reallocation.
Now, another thing that
Economists may tell me
sometimes is that
this reform
decreased massively the wealth tax payments faced by taxpayers, and this may lead to income effects. So taxpayers are just richer, and
therefore they act differently.
So here I believe that this is not something
That is
driving the response, and look at that in three different ways. I look at the response for different level of wealth, for different level of income, and by predicted fiscal gain. What I find is that
actually the response is
relatively flat
along these three dimensions,
and especially
the predictive discovery,
which means that
those who benefit
the most from the reform
are not engaged more or less into risk. It allows me to rule out that this potential
income effect is
driving the results. Now let me provide you one important detail about the French context. So at the same time as the wealth tax reform,
there was an additional
reform
which introduced flat tax rates on financial income from 2018. And this reform has been shown
to trigger
a massive retiming in dividend payment
among the firms,
especially
among the
property owners who own
their firm and
pay out a lot of dividend. And I actually
can observe the business owners ensure that when I
exclude those tax periods from the response, it doesn't affect my results. So here,
I'm kind of confident that this is driven by the wealth tax incentives rather than a retiming response or other types of response.
But importantly, this
additional
reform,
which
basically
decrease
the tax rates on dividends and other financial income,
it did not touch
the tax rate on rental income,
enlarged
the tax gap between real estate and financial assets. And so this may
also play a role in
it
provides more incentives
for the to reallocate. And so in the cross elasticity computation, I show how this can affect. So it actually decreases even
more the cross elasticity,
and then
it provides a bound for elasticity. So I'll show you the elasticity computed when accounting only for the wealth tax incentives and for accounting
also from this
for this additional reform. Now let me.
Yes.
You alluded to this earlier. But so your control group is these non-French citizens who own property in France. And this is 2008 to 18, right? So this is like a period of instability, let's say, in the UK and in the US and some other places. Do you think some of this is just people moving their assets into a safer economy? Like if I'm an American citizen, I have the option of putting some money in France instead of whatever's going on here?
Yeah. I think it's not the case
because
still the UK and the US are important groups, but there are
other groups like
Switzerland, Belgium,
which account
for large parts.
And also when looking at
the time series, it's really driven by a drop from the 1 year, a big jump from the non-resident.
Which kind of, I mean,
of course, we don't have the counterfactual
without these big shocks, but yeah. And also, I mean,
the fact that for the reform, the two groups are very similar. And of course, things happened in 2016, 2015 as well.
Which tells me that we should, if these two groups were not comparable at all, we should not see
not significant.
This is a test, at least. All right, and now let me give you, before moving, let me just give you sense of how dividend income evolved around the reform.
So here,
so I don't observe the financial asset, but I do observe
financial income. And what we see that after the reform,
the level of dividends
increases relatively substantially for the wealthy taxpayers compared to
the country.
Importantly, the specification is a bit different. The
non-resident are subject to non-double taxation
countries. So here the control group is different. I look at taxpayers who are below the exemption, which is
a classical,
quite standard strategies in the.
All right, let me now move on to the
cross elasticity estimates.
So the
cross elasticity concept that I use here is a bit different from the standard literature, in the sense that I do not express it in terms of the
net of tax rates
on financial asset, but expresses the tax differential between housing
and financial wealth. In the end,
since most of the tax differential is driven by the drop in the tax rate on financial assets,
is quantitatively
the same, and I will show you both estimates.
But this
cross elasticity, which is actually a semi elasticity,
makes it more explicit
that it's really the
tax differential
that matters more than
the tax
rate on financial.
And so it
Basically tells us
the
percentage change in taxable
housing wealth in response to
1
percentage point
increase
in the tax differential
housing.
and financial assets. And again, the 2017
Wealth tax reform in fact is quite
useful for
estimate this parameter because it increased
the tax differential without changing much more about the taxation.
So I instrument the tax differential here using the treatment assignment status and the post dummy
And estimate
here the cross elasticity.
where regress
It's basically very similar to the definitive graph before. I
regress the tax.
taxable housing wealth.
So what do we get?
So the standard
My baseline
semi-elasticity estimate is equal
to 4.70, which means that if
to
you
increase the wealth tax differential
between housing
and financial assets by
1 percentage point
that period respond to this
by relocating
on average 4.7% of the housing wealth. So here
across elasticity of 4.7 may seem
extremely large
large, but here it's
again
an elasticity with
with respect to the wealth tax rate
and a 1% wealth tax rate is massive. So I construct
into
elasticity
with respect to the financial the tax rate on financial on capital income, sorry,
which is
0.24, which is actually rather
rather small.
elasticity.
And this is what I
I mentioned before,
so when
we take into account the flat tax
reform,
on financial assets,
the cross elasticity
T is equal
now to
3.8.
So if you believe that actually this second reform had also a very important
Impact
more think that
the cross elasticity will be
lower than 4.70, which was
already relatively small. Now move on. So
how large is the cross elasticity?
of
4.7.
there is no direct
Direct point of comparison
in the literature looking at this very specific question, but there is a lot
large literature documenting the portfolio reallocation response
to
tax differential,
to income tax
tax differential, inheritance tax differential,
also
wealth tax differential,
when looking at different.
different types of financial assets.
I translated these estimates from the literature into a comparable
Cross elasticity
to compare
mine estimate
here to what is found in the
But we first see that there was a wide variety.
of estimates.
There is just
No conversions because the types
of assets vary a lot, because also the type of data vary and the techniques.
as well.
And second, what we see that
My estimate here of cross elasticity between housing and financial wealth
is much more modest than what is typically
defined when
looking at
circulation across different types of financial assets.
now. How much does it cost?
In terms of government revenues, tax real estate
Relatively more. Well, armed with the cross elasticity
that I just estimated, I can actually
decompose the drop in wealth tax revenue after the reform
into a mechanical component.
and a behavioral
So here in light gray is the evolution of wealth tax revenue.
revenue that is observed in France over time. So what we see that after the wealth tax reform, these revenues have drastically
Because
the financial
assets are no longer taxed,
and also some taxpayers fall below the exemption threshold
because they have
have no
housing wealth.
to be liable.
And so
So what we find
is that this mechanical
impact
of the
portfolio
of the reform is very large
large in terms
of tax revenues,
but the wealth tax revenue have been actually
between 9% and 30% higher without this rebalancing.
so I mean it's not massive,
But it still needs to be accounted for in the
potential consequences of the reform. Now, what explains
this modest response.
I think the most important here is that owner-occupied housing constraint portfolio
Choices. This has been
widely documented,
mentioned in the finance literature,
but this is also
very
when we look at the top
of the distribution. So first in this graph,
I displayed the old here in dotted line is the old definitive graph, and in plain red is when we look at housing wealth when excluding
primary. So what we see is that the response is substantially
larger when we exclude primary home,
which just suggests that
primary home constrained
household portfolio choices. And
the cross elasticity estimates here
in this context
are much larger.
we have our
Baseline cross elasticity
is now 7.2, which is substantially larger.
And here it's a second graph illustrating the fact that portfolio
Primary home constrained household portfolio.
what I do here, it's
It's a heterogeneity exercise
where I rank taxpayers
according to
the share of their total housing wealth that is primary
residence. So at the very top,
here. The share
is very low. So it's the share of non-primary housing. So here the share is very low.
while here
P0,
P20
basically they what we see is that there is a very clear gradient as the size of primary
home
decreasing their housing
wealth,
well,
the size
of the
is just more and more important. I mean, there is something for here, of course, taxpayers
do not, but it's very
very visible here and played
actually
a role in the response to the wealth tax.
Now,
housing wealth is
not only primary
home, it can also be secondary owner-occupied housing.
and limitation here.
With my data is that I cannot distinguish when looking at housing wealth, what is secondary housing for investment purposes from what is just home for vacation homes. But I have information of
which provides information on how the housing
wealth is used.
So here I run a second heterogeneity exercise
By
splitting the treatment group between
those who own any rental income before the reform, so therefore have
investment housing,
and those who don't. And what I find is that
there is no significant response
for those who own no investment housing, so no rental income, and the entire response
comes from taxpayers
who have some
investment housing. Here it suggests that this result suggests that even beyond
the role of primary home,
secondary
owner-occupied housing
also constrains household
portfolio choices. And this is easy to understand. It
can be driven by
either the cost of moving because it's very costly, or just because there is people care about having a secondary housing. It's the concept they increase their utility. They are just consuming
housing services.
So this was for the first
mechanisms.
Now the second
is the
of tax avoidance and the little room for pure avoidance in the French context. So it's a well-established fact in the public finance literature that the wealthy taxpayers and high-income taxpayers are particularly elastic to taxes. They are very responsive to taxation. But what allows me to reconcile these findings from the finding in my paper, this high elasticity of wealthy taxpayers is primarily driven by tax avoidance. And this has been shown in the context of income taxation, is income shifting of taxpayers or retirement response of taxpayers. And I found that this is also the case in France. Actually, the response is relatively small because the avoidance opportunities are rather modest. First, there is little avoidance opportunities. So it's, as I told you before, it's not possible to reduce what's taxable real estate without really selling properties. There is one exemption, which is shares of listed companies investing in real estate. So if you want to continue owning real estate, you can actually invest more in such shares of listed companies, and this is subject to the wealth tax. And I find that so I don't observe this asset specifically, but these firms some dividends that are more taxed than others. So they are taxed differently and they are reported separately from the rest of dividends. What I find is that there do not seem to be a massive increase. So here it's significant only 1 year, but the rest it's not. And when you look here at logs, there do not seem to be a reallocation of dividend toward these types of investment. Yeah.
So what happens to your tax liabilities if you restructure your investment real estate properties? You say before you've owned them outright, and then can you restructure them somehow, create an LLC or do some sort of finagling that gets you around having to then puts your real estate asset suddenly from the property tax category into the financial asset tax category?
So yeah,
So actually,
it would not. The bottom line answer is possible to do that. So it would only be
the case if it's very like big listed firms
who would own real estate, and it's you yourself. You
set up a company to put housing.
wealth.
I mean, if it's
Qualified,
as business assets,
it would not be subject.
subject to the wealth tax.
But if you were
Able to do that, there is no
reason to not do
do that before the reform, basically.
Because before you would pay taxes on that too, but after, but then it's business assets. I see. Yeah.
yeah, so
if it qualifies as business assets, it would never be subject to the wealth tax. And so my interpretation is that, so first, the tax base is quite broad, so it's not easy to just, relabel your housing wealth.
and there are two ways
Of doing that is
to own these types
types of listed stocks, like
of firms which invest in,
in the housing wealth,
but it doesn't seem to be the case. And the other one, setting up a company, working in this company to own real estate.
but this, if you were able,
So then
I
might
take it that people would just do it before.
and again, since
Since the tax rate on housing wealth,
has not increased,
this is what allows me
to think that this
to make
the primary driver.
And so
So I investigate the role of avoidance further
by
doing a
heterogeneity analysis
and rank
the taxpayers
according to their baseline.
tax planning strategies. So actually,
There are some taxpayers can
benefit from
a wide range of
tax credits,
for the wealth tax. So
so they can do charitable donations,
donations
so they can benefit from tax shield. So there are
various types of
tax credits, and
I
test the fact that
taxpayers who engage more in these
tax planning strategies may be willing to change more
more their investment, their post. And so, but when I do that,
they do this heterogeneity
ranking taxpayer according
according to whether they receive a lot
of tax credit
or not.
for the reform
Actually, the response is very similar.
for the two groups,
We suggest again that
that's maybe
tax planning
or tax avoidance
may just not be a primary driver
here. So taxpayers are actually rebalancing their portfolio
and selling real
properties
Here, importantly, I control
for baseline
like housing wealth. So this may be
correlated with
with many dimensions of household portfolio, which
which may be
have an effect on the portfolio allocation. So here I control
for baseline
like housing wealth to be sure that this is
really capturing tax credits. Let me
since we have some time, let me also show you one heterogeneity exercise.
oh no let me go to that later.
I just wanted to mention that since
So quite surprising result is that
there is little variation along the wealth distribution. So it means that the very rich, they do not rebalance more than the
less rich,
which is a bit ad hoc.
with at odds with the standard expectation
That we may have, which also
allows me to rule out the possibility that risk aversion
may be
driving the
results here. Risk aversion has been documented as
much lower at the top of the distribution, or other explanations
such as fixed participation costs in financial markets. And so the third mechanism here is
portfolio diversification that plays a role. So the
finance has mainly focusing on
rebalancing across financial assets.
the estimate that
Before, we are basically rebalancing
across different types of pension plans
or equities and
bonds,
but just realistic.
different assets.
And it's been shown by Maurice Cholaric and co-authors that there is a very low correlation between house returns
And stock returns
over the long run. So after World War II, especially. Before World War II, it was a different game. After World War II, there is a very low correlation between them. which means that it's just maybe optimal for taxpayers to keep some housing wealth in order to hedge financial risk, because the two risky assets are not correlated.
And so I checked this possibility
By doing another
heterogeneity exercise and ranking taxpayers according to their level of financial risk in their portfolio.
and what I find is that
The taxpayers who have a lower level of financial risk in their portfolio or the reform,
they are actually
engaging more
in
portfolio management, which is consistent with the idea. I mean, it's more subjective than
suggestive and definitive, but it's consistent with the story that taxpayers they want to protect themselves
against and engage
more in
portfolio
rebalancing if they do not face so much financial risk.
Again, here I control for baseline
Housing wealth, which may also
also be correlated here.
which may be an important driver of the reallocation. And the fourth
Mechanism that I looked at is financial literacy.
or advisory. Here again, it's more suggestive.
But I think it's still interesting in this context. So they've been
Financial knowledge has been documented as a driver of well-performing, profitable portfolio in the finance literature. This is actually well. On the other hand, in finance literature, the role of tax advisors and tax preparers has been shown as key for tax avoidance and tax compliance behaviors. So in the context of corporate income taxation, but also income taxation.
and here in the French
Context, the data allows me to look at the role of tax preparer and tax advisors in broader financial decisions,
because I can observe
when a tax preparer actually prepares file a tax return
of the tax.
for taxpayers.
So it's importantly it's only
19, so there is potentially selection here, which means that taxpayer maybe they want to engage in portfolio rebalancing. They may also look for financial advice and have a tax preparer,
but this would go in
the same direction. So I can test whether
this tax preparer
they provide financial advice or if there is this selling. What I find is that actually the taxpayers who file their tax return with the tax preparer are much more likely to engage in portfolio
balancing, which is again is suggestive,
but it's consistent with the story that
these tax preparer
they are also maybe providing financial advice more generally. All right, so I'm a bit ahead of time, but
I'm happy to take question after.
so as a way to wrap up, the French housing wealth tax, so after the reform, has several appealing features, which are a progressive
Schedule at the household
level,
So
which means that the idea that
it's progressive, but we care about
about the wealth of the household and not
the price of the property, which is a nice feature. And
there exists some progressive property taxes, but at the property level,
this is different here. Second, the market
value assessment, which is different in property taxes. For example, in France, in the case, the taxable value of properties
is not really
correlated with
the market value of the properties. It includes both directly and indirectly held real estate,
and it's possible to
to deduct from the tax liabilities. So its potential,
it's like a nice
it has nice features. And this paper shows that such taxes, which are progressive
progressive and exhibit
high tax rates at the very top of the distribution, they do not trigger a
massive portfolio rebalancing, even among the very rich, who are known to be sophisticated.
sophisticated and good at avoiding taxes. So this
Suggests that this type of progressive property taxes
may have the
potential to raise substantial revenue at a relatively low efficiency cost.
suggest
That progressive property tax maybe or a more efficient
and equitable tax
than many taxes
is on real estate.
that we know today. And I stop here and happy to take
Questions.
Let me ask a kind of a basic question. So if you think of the ideal experiment that you would like to be able to do that you cannot do. You will have the whole French economy first without the change in the tax structure, the wealth tax structure, and then after, run it twice, and then you can compute exactly your cross elasticity, right? So you cannot do that, of course. And you have this control group, but this control group is very different from what the control group would be in that perfect experiment, because it's people that are only subject to the housing tax, the real estate tax, right? So you are not seeing what the counterfactor will be in terms of the value of financial wealth. So how is it that it still works as a control group? In the perfect experiment, the control group will be identical. The only difference will be, the structure of the wealth tax. Where is it applied? Here, the control group is rather different, but it still work as a control group. Why?
So what you say that if the wealth tax to apply to the
entire
French population,
then the control group would not work that way. Is it
what you have in mind?
Oh yeah, imagine an impossible experiment. You have there's no reform, and you see the evolution of wealth over those 2 or 3 years, and then you have what happened. But the control group there will be different. Will be people that are subject to both the real estate tax and the financial wealth tax. The control group that you have is different from the control group in an impossible experiment that you would like to do or cannot do, right? So I want to get more intuition of why it still works.
So I'm trying.
Yes.
Understand.
100%.
But so
I agree that it's not a
control group that is
often used
in
this measure, and so a potential
element that is a bit disturbing is that maybe
those guys they
would buy the housing that are sold by the taxpayers respond to the reform. So if this is what you have in mind,
I mean, I don't know what in a counterfactual world what would have been the evolution of the wealth on financial wealth, basically.
Okay. No,
we don't have that control group to know what would have been. We have this that only is subject to the,
I see. I agree 100%. Yes.
So it's true that what we care about in the end, it's less
the evolution of housing wealth than the evolution of wealth. And it's true that what I showed you today
is basically
how the housing wealth evolved. We should be a good proxy for how financial wealth evolved, but actually we don't know. So it's true. So I think in terms of tax revenue, it's important to see how housing wealth evolved, because of course, if housing wealth decreases, then it's just less revenue for the government.
And then, yes, the non-residents, they are not subject to the wealth tax for how much
financial wealth they own in France.
So it's a bit of
a different
types of group. If we really care about
how investment in financial markets,
but I can agree with that. So the French taxpayers, they increase their level of dividends after the reform, which is suggested that actually they have reallocated
their wealth towards
financial assets.
And this is when using another control group, actually, those who are below the exemption threshold.
And I also have in the paper a specification where I do not compare
the French
to the non-residents, but I compare the French
to the French with basically only their primary home to see how it evolves.
And I mean,
the response is very, very close in terms of housing wealth, how it evolves. But I agree that a blind spot of this, so it's a lot about housing wealth. While what we care about is also the own elasticity, like financial wealth, and it's a bit a blind spot of this paper. I don't observe it very well.
I think it's probably some identification assumption that is implicit that you are making, but was not explicit, probably. Right? there is some identification assumption, I think, about some constancy of something, some proportion. There is some, I see that there must be some identification assumption that you are making that may be completely reasonable. It's just that it's not clear in the analysis, like.
Okay.
Yeah.
The main, yeah, maybe you can discuss it
Later, and
Yeah, sure.
so the main assumption I make here
is
under
reform, the evolution of housing wealth of the two groups.
have been similar.
So this is the main identifying.
Exception.
But that doesn't tell you in the counterfactual world what the evolution of financial world would have been. That's the issue. Imagine that for whatever reason it still would have increased, then it wouldn't be driven by the tax, right?
What I care about
About is
really the additional
financial
that is driven by
by the real.
allocation, but then there may be many reasons why financial wealth has evolved over time, because of savings response, because of other reforms, because of many things. And so the parameter that I'm after is really the additional financial wealth
Well, that is
really driven by the tax differential
not, yeah, I'm not after other factors that
may
may
affect.
financial assets. But I'm happy to discuss.
Because it,
Yeah, sure.
thanks a lot for the question.
I'm just sort of curious about I guess the broader context of how this was received when it was proposed and how it's viewed now. Like, it seems like you've done a very convincing job of showing that, like, this was a huge tax cut. It went only to the top 1% of people in France, and it maybe didn't have the effect that it was intended to. Is it seen as a mistake? Was it controversial at the time?
So I think, so I don't
I don't
know
know if you've heard about the yellow jacket movement in France. So at that time,
time
the repeal of the
wealth tax
was really
something that triggered more demonstration.
and contest.
So I think
I think the government at the time in Emmanuel Macron
paid a political
cost.
so the rationale
Rationale was to say that
it was
necessary to
build a pro-business
platform. So at that time, this wealth tax was
repealed or changed.
changed.
The flat tax on
Financial income was introduced, and
also the corporate
corporate income tax
drastically reduced.
reduced.
The idea was to say that
Even though some
response
some people showed that okay, it didn't work as intended, there was a message sent to the world.
world, and then of course it's impossible to estimate the causal effect of
This message,
but the idea was to attract
startup investment,
foreign
investment,
and make
make France great again.
Yeah, I have a question I think follows up on what Niels asked earlier about like LLCs and stuff. We're just like trapped in the American context. I'm struck by your finding that the effects were so much bigger on people who had rental income, right? Because rental income kind of sounds like a business. So is what happened that like some kind of small landlords got out of being landlords?
you're struck
But the fact that the response comes from people who have rental income.
Yeah.
So how it is basically a household would own a primary home, a secondary home,
and then
two apartments just for rental income.
Yeah.
and I find it that
These types of household, they would sell one of their apartments.
Yeah.
Keeping their like own
the occupied house
housing and sell one of them.
Yeah, I'm just interested, like, so what does that mean? Like, did that apartment become owner occupied by somebody else? Did it become a commercial asset for a bigger, it sounds like a housing market reallocation story.
I think it's
Fascinating question. So
I'm yes. So the blind spot of here is so I observe
observe what is reported, but I don't observe the properties.
but I mean now I'm actually working on a follow-up project where
Housing economics or
urban perspective
to look at the occupancy rate. I mean,
prices first
at the very local level, and occupancy rates, first time owner,
owners,
and also
whether this can be
related to capital gains taxes, because I mean there is a decreasing schedule of the capital gains tax. If you have held your property for more than a certain amount of years, you pay less in capital gains. So I mean,
yeah,
I think observing the properties where they're located and looking at like the use of this property would be, yeah, super interesting. I agree. Yeah.
Yeah, so follow up a little bit on Pablo's question, and I always get a little bit confused when with elasticities. So it's kind of like the way this works is that you identify an effect of the tax on housing wealth based on the treatment and control groups, where the people who do and do not live in the country, and then you're kind of using that estimated effect to identify what the portfolio reallocation is with financial assets within the group for whom you observe the financial assets?
Yeah.
Okay.
And so you just
I assume that the
tax rates on real estate didn't change for the control group, and neither did the
tax rate on financial
business. The tax differential only changed
for the treated group, and therefore I can
basically divide
the magnitude of the
by
the tax difference.
I'm still thinking through sort of the implications of your research for like, how do we tax the rich? Because that's how you started. That's what we're all thinking about, right? And so,
yeah,
you say it's fair to summarize this, that portfolio reallocation doesn't really, maybe is not that big of a deal, and just tax the rich.
I think
we'll talk about portfolio allocation between real estate and housing wealth. It's not that big,
but I think
portfolio allocation will be
focus on
assets will be massive. And what the experience, the history tells us is that there are some exemptions. For example, in Spain, there have been an exemption introduced in, I think it's 1993,
which exempted
completely some business assets if the ownership rate was greater than 15%
from wealth taxation. And it's a paper by Emmanuel said who showed that basically
the share
of exempted assets
just massively increased, and
it's just
avoidance taxpayers
taking advantage
of these loopholes
rather than
truly portfolio allocation.
And if your question is about
how we should tax the rich,
I think if you really want to maximize revenue
and limit avoidance opportunities, you need to have something as comprehensive as possible. And again, it's true that this paper speaks more to how we should think of the relative tax rate of real estate as opposed to other assets. And and
not really about
design a billionaire tax, for example, debated in
Yeah, a question for another person that is locked in the American context, right? So here we obviously don't have a national property tax. Property taxation is done at the local level. I'm curious about that in France. Is there a local property tax such that this wealth tax is then like stacked on top of that for wealthy households, or is there no local taxation with respect to property, and this is the only kind of taxation? To which my question then would be, how does the government then think about using this property tax? What is it specifically deployed the revenue from and used for?
Yeah, I should have much.
So there is a property tax that applies to every properties in France. That is, I mean, the revenues goes directly to the central government, but there is the property tax. And in terms of
total revenue is much higher. It's around, I think, on top of it,
2 billion euros.
While this, after the reform, is more around
2 billion.
So it's
really much higher
in terms of revenue.
And then
yes, it's
the existing property tax in France, which is called taxe foncière. It's a weird tax because the taxable value is so far away from the market value. This creates a lot of horizontal inequity for many reasons. Yeah, I think that there would be a lot of things to this. I mean, the purpose of this property tax is really to raise revenue, while in this context, at least from the beginning, it was really to redistribute. Yeah.
Do you think there was any effect on real estate prices? And how that will affect your estimate?
Yeah, so this is it's a good point, and
I think so what we see at the global level in France, I mean French level,
is that house prices increased in France after the reform.
Even in the
The expensive areas, like the posh neighborhood.
in Paris,
So I think that at the very
aggregate level, it's unlikely
to have had
big effect on prices. That said, I think
that in a very
in very localized neighborhoods where a high share of
total
housing,
is held by French taxpayers
it's possible that this
affects
this
has affected the prices.
my assumption is
That
this should be
accounted for.
with the control group. So
I'm not looking
at the evolution
of housing
wealth by the French,
but really relative
non-resident should account for this potential
effect on prices.
If it affect prices, I'm not sure I follow. Even if the price of real estate increase, it could have increased more absent the reform, right? So the fact that the increase doesn't tell anything about the effect of the reform on real estate prices per se.
Just
rule out any massive
house price effect that
we maybe
see if they were like the shock
was
extreme in the risk.
but then yeah,
So the idea is to say that
okay, if the price decrease, then the reported
housing
wealth should
decrease.
among the French, but then this should also be the case for the control group that should control for this.
The prices.
And this is a bit what I try to
To show with the house
price index, the slide on the house price index,
that
the house price inflation
inflation faced by the non-resident and the French is on average
average
similar.
over the period. But of course, I
I
think
think
at the very local level and in some examples, I think you're right. I'm quite confident that there were some like effects in some areas, just on average. I think it's second order to for what I find here.
Just thinking more about the price. I mean, it seems like if there was a price effect, it would help explain your low elasticity. So if it does exist, it goes in your favor, at least of explaining what's interesting. But I would also be curious to see, like, since these are really wealthy people, the houses they're trying to sell are really illiquid. I'd be kind of curious to see if you if there's anything to be seen for like time spent on market or like number of listings, or this wouldn't be in the tax data, but for some of these like really expensive neighborhoods, it would be interesting to see if there's some sense that like those markets became less tight or something after the reform.
Yes,
I think it's a good point. So in the end,
how we interpret this
this relocation is not selling their castle.
or they're raising like apartment.
Yeah. This is why I think
This
would not be so much.
although I mean it would be I think
It would be super interesting to look at a very specific segment of the housing market.
market, although
I don't think it's the majority,
but it may
but here really
what I find is
70% of the
total effect is really
of the first year in 2018, which rules out any like difficult, super hard difficulty for taxpayers who just
wait for years.
years before to sell the castle.
Yeah, this I think the fact that
It's really driven by investment housing.
without this
So you showed this 9 to 13% drop in your revenue from the wealth taxes or the result of this shift towards financial assets. And you also said that these financial assets then can get taxed as income if you have dividends from them. Is there, what degree of recapture are you getting from that income tax? I'm assuming it does not account for anywhere near the total amount that you've dropped off in the wealth tax, but I'm just curious how much actual recapture are we getting?
Yes, so you should think of this as a
lower bound because indeed
there is the income tax,
tax
and on average,
the tax rate the
income tax rate on financial
potential
income
is lower than the income.
income tax rate on rent.
So here I'm not
I'm not
accounting
accounting for this fiscal externality.
externalities, but if I were, you should think of this revenue impact as higher than what I show because of the rate is just
Different
for the rate is higher for rental income than for insurance. And also another thing, since the tax schedule is progress, if there is rental income paid received by someone who is low on the income tax bracket, the amount of tax paid would just be lower than if the person is very rich. Marginal tax rate would be different. That would be another margin of decrease in the tax revenue that I don't accounting for because I would need many assumptions about who buys, etc. But yeah, at least you should think of this as more as a lower route.
All right, we'll wrap it up there. Let's join me in thanking Ségal.